Interest expenditure deduction, understanding the limits and conditions for corporate tax purposes. In the course of conducting business, companies frequently borrow money or take out loans to finance their operations. These loans might be used for various purposes, such as purchasing assets, covering operational expenses, or increasing working capital. As a result, interest on loans is a common and often substantial expense for businesses. Interest expenditure refers to the cost a business incurs when borrowing money, and it is typically treated as an operating expense that can be deducted from a company's revenue when calculating taxable income for corporate tax purposes. However, while interest expenditure is generally deductible, there are specific rules and limitations governing its deductibility. Understanding these rules is essential for businesses to ensure they remain compliant with tax regulations while optimizing their tax position. 1. What is interest expenditure? Interest expenditure refers to the costs a business incurs in relation to loans or borrowings. When a company takes out a loan or borrows funds from a financial institution or other creditors, the lender charges interest as a fee for providing the loan. This interest is typically calculated as a percentage of the loan balance and is paid periodically, often annually or semi-annually, over the term of the loan. For example, a business might take out a loan to purchase new machinery or to fund day-to-day operations. The interest paid on that loan is considered interest expenditure, which is an operating cost that can reduce the company's profits. Since it is a necessary and ordinary cost of doing business, it is typically deductible when determining taxable income for corporate tax purposes. 2. Deductibility of interest expenditure. The general rule is that interest expenditure is deductible when calculating a company's taxable income. This means that the business can subtract the interest expense from its revenue, reducing the overall amount of income that is subject to taxation. This deduction helps to ensure that businesses are not taxed on funds that they must pay to lenders as a cost of borrowing. For example, if a company earns AED 1 million in revenue and incurs AED 100,000 in interest expenses on its loans, the company's taxable income will be reduced by the amount of the interest expense. As a result, the company would only be taxed on AED 900,000, the revenue minus the interest expense, which reduces its overall tax liability. 3. Limitations on the deductibility of interest expenditure. Although interest expenditure is generally deductible, there are some important limitations and restrictions that businesses must be aware of when claiming this deduction. These limitations are designed to prevent businesses from abusing the interest deduction as a way to reduce their taxable income excessively. A. Thin capitalization rules. One of the key limitations on the deductibility of interest expenditure is the application of thin capitalization rules. Thin capitalization rules are designed to prevent businesses from excessively leveraging debt in relation to equity in order to artificially inflate their interest expenses and reduce their taxable income. Under these rules, if a company's debt-to-equity ratio is too high, meaning that the company has an excessively large amount of debt compared to its equity, the interest on that debt may not be fully deductible. The objective is to ensure that businesses do not use debt financing to excessively reduce their tax liability by claiming too much interest expenditure. B. Transfer pricing rules. Another important limitation is related to transfer pricing. If a business borrows money from a related party, such as a parent company or subsidiary, the interest rate charged on the loan must be consistent with market rates. This is known as the arm's length principle. If the interest rate charged on loans between related parties is artificially high or low, the tax authorities may disallow the deduction of interest that does not reflect what would have been charged between unrelated parties in an open market transaction. In such cases, the business could be required to adjust its interest expenditure to reflect a fair market rate, and any excess interest paid could be disallowed as a deduction for tax purposes. See interest on loans for non-business purposes. Interest expenses that are incurred for purposes unrelated to the business's operations are also typically not deductible. For example, if a business takes out a loan to finance a personal purchase or an asset that does not directly contribute to the business's activities, the interest paid on that loan would generally not be deductible for corporate tax purposes. D. Debt withholding tax. In some jurisdictions, interest payments made to non-resident lenders may be subject to withholding tax. This is a tax levied at the source of income on the interest payment. In these cases, the business may be required to withhold a portion of the interest payment and remit it to the tax authorities. While the business can generally deduct the full amount of the interest paid as an expense, the withholding tax may impact the overall tax treatment of the interest expenditure. E. Excessive interest deductions. In certain cases, if the business is claiming excessive interest deductions relative to its income, tax authorities may impose additional restrictions or adjustments. For example, tax authorities may scrutinize situations where a company claims a disproportionately large interest deduction that appears inconsistent with the nature of its operations or financial position. In such cases, the authorities may challenge the deduction, and the business could be required to provide further documentation to justify its claim. For example, deducting interest expenditure. Let's consider a simple example of a business that borrows money and incurs interest expenses. Company X has a revenue of AED 1,200,000 during the tax period. The company borrows AED 500,000 from a bank at an interest rate of 5% per year. The interest expense for the year is AED 25,000, 5% of AED 500,000. Company X also incurs AED 10,000 in other expenses. The taxable income for Company X would be calculated as follows. 1. Revenue, AED 1,200,000. 2. Interest expense, AED 25,000. 3. Other expenses, AED 10,000. 4. Taxable income, AED 1,200,000, AED 25,000, AED 10,000 is equal to AED 1,165,000. Therefore, Company X's taxable income would be AED 1,165,000, and the company would be taxed on this amount after applying the applicable corporate tax rate.